Hello and welcome. Today we're going to go ahead and cover some of the scripts that are involved with the Diamond Pro package and how you can possibly use them going forth. Okay, so let's go ahead and jump right into it. I'm going to go ahead and look at Spy because that is what everybody likes. So, what the Hades is going on here, right? You get a bunch of this, as Julian would call spaghetti, all over the place. So on this, what I'm looking at changes in implied volatility. I have a uh, stochastic momentum index divergence tool. Basically, it's going to change colors and it's going to have some arrows on there when there's a divergence present. So if you like a bullish divergence, would be that would be price is moving down while the oscillator is moving up. And usually what corresponds with that is usually a bullish move up higher. And sort of see that. Let me see if I can find a better example in the past time frame. Give me just a second. I guess the other nice handy dandy part about this is it's going to show, it's going to suggest buys based on, that previous idea of there's a bearish divergence or there's a bullish divergence. The green arrows are signifying that a bullish divergence has occurred, meaning the oscillator is going up while price is decreasing. And it's going to suggest a buy there. As you can see out on SPY on the daily, it would have worked out pretty nice. What I would have done, since I try and keep a cautious and open mind about what's happening in implied volatility. So that gives you a baseline of what strategy you should do. So if you're expecting a price to move up while volatility is moving down, the best strategy for that would be either in-out debit spreads or credit spreads. Some people like to use calendars when volatility is decreasing or, the ranges are decreasing, but it's tomato tomato. So one thing you have to keep in mind, you see this and you're like, oh, I've got all these nice fancy tools. Well, you know what? There's no crystal ball in the market, no matter where you go, what oscillators, what technicals you have up. So the best risk management is having proper size, having stops set in place. If what you expected to happen doesn't happen, you need to have a a B plan. How do you eject from the plane, before it crashes? Or you also need to have profit targets. So this whole system, the whole idea here is just to identify, basic technicals, and then from there you need to make a conscious decision based on what's happening in volatility, strategy wise. So let's go ahead and I'm going to remove each one of these so you can see what each one does. Implied volatility is a built-in one. The SMI divergence one is one that I kind of made up, which is based on, stochastic momentum index. It's pretty reliable. The other ones that I have going on are Wedgie. Wedgie is that's just trying to identify when there are multiple occurrences of so there's multiple occurrences of a consolidation period happening. So I have a scan based on that, or that I have. It's just basically saying it's an if and statement. So if this is true, I want you to show me when it's happening. So one that I'm already looking at based on what the scan told me is FedEx. Now, it comes with a grain of salt how you do your trend lines. I know this looks crazy because I have trend lines that I draw personally, and then also the little system generates its own trend lines and support zones. But I mean, the basic gist is that you have a basic idea of where the buyers and the sellers are meeting, and then from there you need to be patient and you need to wait. So, for instance, on FedEx, I'm looking at this guy, upward facing trend, moving into a consolidation period. The wedgie is blasting off saying, "Hey, there's some kind of event that's getting ready to happen." It doesn't necessarily, you can't really infer like what is going to happen, but the whole idea is that there are moments. It's kind of like an accordion. So when the accordion goes in, sound collapses, and then when the accordion goes out, sound expands. So it's kind of the same effect with volatility when you come into consolidation periods. So that's one reason why I like that little tool, Wedgie. That's what I called it. You can't judge me. I have a weird sense of humor, I guess. I don't know. All right, so based on this trend, I'm thinking it's more of a bullish trend, likely to break bullish. But you know what I'm going to do? I'm going to sit back and I'm going to wait. And one of the best things that you can do, that I often do, is tap create alert. Say, in your note, you could say uh, breaking resistance. Of course, I can't spell. I'm a trader, not a speller. Uh, so breaking resistance, uh, based on this whole pattern, I would assume that this is some kind of bull flag. Bull flag. So we have to enable. You can have it play a sound for you. You can have it send an email to you. You can have it send a text message to you. It can have push notifications. You name it. But having the ability to set an alert, like when a specific level is broken, that's what's going to make this whole system almost like magic, along with the sizing and then the stop losses and profit targets. But that's up to your own judgment to make as far as how you want to make those executive decisions. Personally, let's see, based on that idea of what happens to volatility, usually when you're in a wedge or a flag or something like that, things get a little oversold. Volatility usually collapses as the range collapses, but here we're kind of seeing the opposite. So I would be more open to possibly selling puts or put spreads somewhere down here because I'm seeing that steady rise in volatility. But I know eventually that volatility is going to come out. You could either do that or you could do like a bull call spread, which is where you buy a call, you could buy an in the money call and then sell one out of the money. I mean, the basic idea there is that you want to have controlled risk, but you're also staying conscious of what's happening in implied volatility. If implied volatility is increasing, you want to figure out what's the best way of taking advantage of that. All right. So I like to have my trades on 3 separate setups. So I'm a swing trader. You know, I like to take small bets on what I think is going to happen in the future when specific technical levels, for instance, this one, is broken. Uh, so the idea here is taking a small amount of money, putting it in an underlining, and being patient and letting it do its thing. Based on the rules you have set in place, your stops, your profits, etc. Main goal here is that you want to wait for it to tap some kind of, like, for instance, FedEx. I would want to wait, one, for the break of this trend line and that alert to trigger, but also a retest of that level. That would give you the best odds of possibly winning. You know, so One of the reasons why FedEx is bouncing is because of stimulus hopes. So if you think stimulus hopes is going to continue, then yeah, there you have it. You got a free trade right there. Same with like Boeing or the small caps. You know. Okay, so I like the daily chart. So daily chart, I mean, my main goal here is to find setups and then set risk parameters, in the direction that I think things are going to go. Uh, so daily chart, I like the hourly chart because the hourly chart shows it generally shows the best entry points. So like I would be if I were trying to scalp, I would want to wait for this 278, 273 or 270 mark to possibly enter. Or I mean, I guess this is more of like, intra week. That would be my targets as what I would be aiming for. For the daily, I would be aiming for this 281 to possibly take a long entry. So 15-minute is what I use for the daily. Intra week, I use the hourly. And then for like a weekly or longer term, I use a daily. So, I mean, based on what I'm seeing here, what my SMI is telling me, I have a good feeling that we're probably going to collapse down. Because, like I said, volatility inside of consolidated ranges is supposed to collapse too. So I'm assuming that we're probably going to collapse down, and the range is just going to get smaller and smaller. So I wouldn't be apt to taking that trade just yet. Especially without other fundamental news backing it up or backing up my thesis of uh, some kind of inflationary event's going to happen. That's how my mind works. Everybody has their own different way. So if I were looking for a bounce play on FedEx intraday, I would be waiting for this 281, possibly 280. But more than likely, I'm seeing prices going up. I'm looking at volume. Volume is decreasing. So I would just stay away. Yeah. So definitely not a play that I would take. You got to use over time you will learn different ways of analyzing charts. And once again, there's no crystal ball. Um, it's all about how you manage the trade. Uh, and that's pretty much life. Put his cat down, trying to figure out whether he should buy Tesla calls or Tesla puts. And his cat told him to buy Tesla calls. So I bet, yeah, but that cat's homeless now. Anywho, so I covered the wedgie. Wedgie is just identifying on the daily chart when a consolidation period is happening and when it's likely to break. I know that's kind of a pain in the butt, but that's how I do it. You don't have to pull your hair if you manage the trade correctly. The next indicator that we will take a look at is the trend is your friend. Now, like all other, moving average type instruments, the goal here is to stay with the trend. Trend is your friend is basically a standard deviation based moving average. So it's a little bit smoother, but it gives a fairly more accurate signal. Basic way of using it, if it's under the 50, kind of like the 50-day moving average, you'd probably want to stay away. When it crosses, I have it set for a 20 and a 50 currently. So when the 20 crosses the 50, that'd be like a buy signal. So that would be a spot where I would consider selling puts or you name it. I guess the whole goal here is just trying to figure out better ways of knowing which direction the trend is going. Once again, no crystal ball, but doesn't mean that you can't have a little bit of tools to help guide you. As you can see, since it's based on standard deviation, you're also getting uh, a decent indicator telling you when you should be buying for possible bounces and when you should be selling. If it's far extended above, it's likely going to be some kind of sell type play. Um, and when it's, right at, or if it crosses, then you could either stay out of the trade or try and chase it down. Um, so let's go and take a look see at some specific examples. Go ahead and pull up Home Depot. Always good to have real-time examples. So, based on, you could change it to what most people use is a so one thing that a lot of people like to do is they like to have these kinds you know, of moving averages based around the 50 and the 200, or what most people see as a golden cross. So this wouldn't be any different. So I'm looking at Home Depot. They had earnings today, and I guess earnings weren't that great. Now, you have a few decisions here. Do you want to chase it, which I definitely don't encourage? I mean, if you do chase, then that 264 or this trend line could act as support. Um, so looking at the break, the trend is your friend is showing that this is likely a sell. So the overall trend is officially a downtrend. Now you see this trend line support. So what you would consider if you're bearish and you're expecting at some point it's probably going to bounce, you could either be patient and wait for this trend line support, which is what I would probably do. Go ahead and create an alert. Say at or below trend support. So if it goes below, get a better gist of how it's probably going to go. But if it hits it and it bounces, it's probably going to be a very hard bounce because it's likely to be in very oversold conditions. And then also, if you look at what is happening with volatility, volatility is falling like a rock because earnings just happened. I mean, I would assume this is probably going to trade a little bit lower, but at some point, I would figure by the end of the week, this is probably going to have a hard bounce. That hard bounce would probably go back up to this 272 range. It's just a guess. Once again, no crystal balls here or whatever. It's just risk management and using the correct tools to make decisions. So, assuming there'd be a bounce, it would likely trade up to possibly the trend is your friend. That would be like the max target that I would be looking at. But likely, I would aim somewhere in between this 270 273 range. Just mainly because there's some gaps, old saying that gaps like to be filled. So I think that's possibly what would happen here. So the next thing that we will look at is, this is like a little earnings tool that I often use. I'm trying to figure out what is likely to happen. You can do it several different ways. I am a bean counter. So I like things that have, consistent results over a period of time. And that gives me a better sense of confidence of how events are probably going to play out. So let's take a look at Costco. Taking a look at Costco, looking on the monthly 10-year, which this one you want to do the 5 year. A lot of people go by the 5 year average when it comes to things like this. It's had 14 gap downs post earnings and then 7 gap ups post earnings. The gap up average is about $4.79. Gap down $4.75. You can see we did have a gap up, and we are currently within the average range of gap ups over time. So this earnings tool does a good job at identifying, the possibility of a gap down versus a gap up. I would have favored a gap down based on, seeing 7 gap ups versus 14 gap downs. So I would have been probably on the wrong side of the trade. But the other go-to thing that I have here is a tool that's, free on the internet by Theo Trade called expected move, basically one standard deviation. So it's showing on the chart what exactly are the market makers expecting. Plus or minus $7.16 was the expected move. Flip back to the chart. Basically, what it's going to do is it's going to graph a weekly expected move. So you get a weekly range of the likely outcomes that are going to happen. So one standard deviation is 68.2% of the time. So 68.2% of the time, it's going to fall somewhere within this range. And if it's an outlier event, it could go outside of the range. All right, so outside of the range, that would be an outlier event. This is something that the options market or the market makers did not anticipate, either better than expected results or, you know, the results are not as hot. Usually when you get not hot results, you can just crack through that bad boy to who knows where. As weird as that sounds, it's silly, but yeah, that's just kind of how it works out. So looking at this bad boy, I'm seeing we clipped that top end of the expected move. We stayed within the average range that was expected. So what I would be more open to doing rather than buying calls, I would be more open to selling call spreads. So I'd want to sell somewhere outside of this range because I'm anticipating that, the results were good. We're about average, or the average move up post earnings. So I feel comfortable that we're likely to stay within this range, meaning, 68.2%. So make sure you drill that in your head. Uh, the more that you know how these tools work, the less work that you have to do. Let's see if we can. I'm going to check it out on a yearly average. So sometimes when you look at different periods of times, you will get different results. I'm taking a look at what happened just this past year. So over this past year, it's saying the average number of gap downs has been 5 and the average gap ups has been 0. So once again, kind of going with the idea that, you know, more than likely things would go lower from here. And it's also kind of pointing out the fact that the best way of approaching this would be by selling upside calls or call spreads, whatever you want to. Tomato, tomato. Once again, same rules, no crystal ball. Accidents do happen. You got to make sure that you use proper risk management by stops, profit targets. So we will go ahead and take a look at another one. Let's see, over this past year. So this is an earnings trade that I would probably I would steer clear. All right. So looking at things, average gap up, two, average gap down, two. So it's like a 50-50 bet in my head uh, what is likely to happen. And yeah, Neo had this crazy, crazy run up. And it's showing that, you know, it's kind of near the top end. But at the same time, seeing that 50-50 bet thing, it doesn't make me feel confident. Uh, Younger companies, also the big thing here is that younger companies, that have no earnings or haven't fully been accepted by the market, they can trade based on stories. If you look at a Tesla or something like that, they don't have any actual earnings. Their PE's around an 800 or so. It doesn't rationally explain why anybody would want to take that trade or be long that trade because they have no real track record. I guess that's what I'm trying to say. Uh, so a story, if it's good enough or positive enough, or if you have somebody charismatic enough, like Elon Musk, you know, it can trade higher regardless of fundamentals. But that's where we go into trader psychology, you know, where it's less about the actual fundamentals and more about the story. So the story itself can perpetuate the move beyond what is expected because nobody knows what to expect. That's how I'd approach Neo. It's like, right now it's a story. I mean, I take stories with grains of salt because I don't believe in Neo. I don't believe in a lot of companies, but I'm not willing to try and take speculative bets against a Neo or something like that pre earnings because I know that's a fast way of getting my head chopped off. All right, so I don't want to dive too deep into that rabbit hole of trading psychology, but basically what I'm trying to say is, if a story is good enough, it really doesn't matter what the company does. All right, so let's do one last one. I am going to pull up Eagle Eye. Eagle Eye is our proprietary algorithm that identifies certain sweeps that are hitting the market, and it kind of lets what's probably popping. Today it mentioned Tesla. So I'm going to go ahead and look at Tesla and I'll give you a brief overview of how I would see it, seeing blah, 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 oversold, given a buy somewhere down here. Would have been a decent entry. And then the S&P 500 news right here. So looking at Tesla on the hourly or uh, intraday long term kind of thing, it's kind of showing, actually kind of looks like a bear flag. So looking at the intraday where I'd mostly hang out if I were trying to scalp this or you name it. You're looking at this guy, say, okay, it's that 434 would be where I would want to enter, or possibly off of the trend is your friend, somewhere around 442, 441. Probably have stop loss, stop loss 10%, and then profit target 15%. You know, not really trying to get a whole lot out of it, but seeing what's happening here, there's a lot of volume going with that. There's a resistance zone that was not cleared, and this is also a long-term resistance too. If you zoomed out on the daily chart further back, so long-term resistance, we popped up based on the S&P 500 news, but we did not clear that resistance zone, so we are likely to stay within this no man's land. for this pennant that we've been in for, or not pennant, but symmetrical triangle that we've been in for a few months now. Tesla has been a very hard trade to take lately. It's been very uncooperative. um, but yeah, so currently looking at this one, this would be a trade that I would probably take based on what's going on our SMI and seeing price above trend is your friend. So I'm expecting it to resume probably to this 451. That would be an easy target that it's likely to hit, but it might not break it. Yeah, so I hope that kind of gives a brief overview of how I use these indicators and how I would, you know, look at it chart wise. All right, face it, trading is hard, but it doesn't have to be super hard. The whole goal of this is to give you basic technicals, you know, to give you better decision making spots, whether you should enter a trade with proper risk management, such as stops and sizing and profit taking, you name it, uh, so you can feel more confident and it's less life draining. I guess that's the only way I can describe it, but less life draining because yeah, our whole goal here is to make your life more fulfilling and happier and easier. And yeah, there's no sense in trying to pull your hair out, trying to figure out where Tesla's going to go next. You can slim it down as much as you want, you know, and it doesn't matter how many indicators you have on. The best thing that you can do is figuring out a system that works for you, but then also doing proper risk management techniques that we mentioned earlier. If you have any questions or if you'd like me to go over some stuff, go ahead and feel free to DM me and we can go over it further on our Discord. All right. Peace.